All right, team. Today we're going to talk about something very important. Should be a relatively short video, but a very important one. You know, I've talked about before. The one of the things that's usually the last to be learned in trading is risk management, and I think the reason why historically that's always happened is just the fact that normally people would learn to trade before trying to trade, but it creates issues. So, I've touched base on it a little bit. I actually did a terrible job the one time I did get into it for a few minutes, but I figured, let me just put out at least one risk management video here that you can watch. Basically, have it in your hands and be in a position to understand some basic ground rules so you can really discipline yourself because trading is about discipline. Of course, it's about eventually learning the technical side, eventually learning the psychological side after you have a good grasp on the technical side. But in reality, risk management's a very significant part of that because ultimately, if you're risking too much, it's going to create some problems for you. So, some general ground rules, right? First of all, you can all write this down, take a picture, do what you got to do so that you can commit this to memory. But pretty simple. A normal risk management strategy is a risk of 1% of your portfolio, 2%, or 3% at max. And if you're not a confident trader, it really should never exceed 1%. Now, what does that mean? What it means is, and this people get very confused about this. They think like, hey, that means that I'm gonna put uh, for instance, I got Litecoin here. If you have a $20,000 account, does that mean you're gonna buy 1% of your account? Of course not. The idea is that the risk is 1%. So we have to go into how do we figure that out? Well, first of all, let's just figure out the risk, right? So I'll bring out the old friendly calculator here. I took a picture of this guy right there. Let's see. Which is the same one, the risk management. I need a calculator now. Obviously, we can do the simple math here, but just so you guys can, when you break it down a little bit more complicated ones, I'm using Litecoin and I'm rounding it. But ultimately, if we say you got a $20,000 account, are we saying that, hey, you know what? Let's go ahead and buy 1% worth because that's our risk of $200? No, our risk is $200. So the first thing we figure out is that. What are we going to risk? So before we even get into this, and by the way, that's a maximum. You can go smaller than that, especially early on if you're playing around. You're practicing a 0.5%, a 1/4%, even less. It's nice that if you have to paper trade, that's fine. But it is helpful to get in and start making the trades a little bit. That can be very helpful. But in this situation, you figure out the risk first. So look, I'm not going to risk more than $200. So one way to do this is that obviously if I purchase X amount at $200 of a loss, you would be exiting. That's a simplified way, right? So if your count started at 20,000 when you entered, and you see that now the P&L is at 19,800, excuse me, meaning that with including your P&L, you're showing 19,800, you would sell, right? So you could see that, hey, my P&L says minus 200, or I'm approaching that, then that's certainly going to be my maximum stop loss. Now, of course, there's other factors in here, right? If you buy here, you're going to have to determine where is my stop loss, right? And we're not going to get the specifics right now. You'll get a whole nother lesson eventually of how to determine that, and what other tools we can use. Some of you guys know something like ATR is a good tool to utilize, obviously. In which case you're going to go. We're not going to get into that right now, but the idea though is let's just pick some numbers at the moment because that's more important. Because first of all, obviously a lot of you might be utilizing the system, right? So with the system, let's say it's a day trading system, same type of thing. You don't want to really lose more than 1% of your account, that's for sure. That doesn't mean the trade can't give up more than 1%. I mean, ideally, you wouldn't like that either, but sometimes that's not reasonable if you're trading an alt, but certainly not your account. So you can watch that as well, and that can be an added caveat to that particular trade. The other side of that would be, if you're in a trade, if you're in something like this, what are you going to determine first? Well, you're going to pick first the levels. Now, I'm going to say something like this. Let's just kind of, in your mind, if you can, let's eliminate these last two candles. We don't have to let you do it in your mind. I mean, I have the power to eliminate them, right? Let's just look like it that. And the only reason I'm doing that, and don't even look at the top of this one, I'm just going to assume that Litecoin's right at $100 because that's going to make everything easy as it relates to our math, right? So let's start with that. And then the first thing is, so here we are, we're pushing up here at $100. We're testing, we're basically going after this high right there. It's given a test. Forget looking back right now. Obviously, yes, you would normally look back. You would map off support and resistance. You would look at your higher time frame, your monthly resistance. You're going to look at your weekly, your daily, etc. Of course, you're going to do that as well. But for the purpose of this, we're going to look into the calculation within your risk management. And the calculation is going to be that you're going to determine an exit. And again, something like the Heikin Ashi system, that's not going to be built in there, but you can utilize that as well if you want to throw it on top of it. But yes, that has color change and things of that nature, and you should be utilizing a small enough portion of your account so that you're not really getting yourself into danger anyway. But ultimately, let's mark off a couple areas, okay? So we're going to assume that it's at $100, so we're cutting off the top of that candle. Here we are, we just swept the highs right there, and we like it. We want in. But we want to know where is our failure point, right? So let's just look at a little bit of a support right there. Obviously, that's a good ways away, right? It's $85. And I'm just going to literally just do the local stuff. I'm not going to go back in time, which you should. Right there, that's even further, so it's not really helping us. Then we're going to put one right there. See this guy right here? He wicked off very significantly. And I'm going to use one that gives some leeway, right? Obviously, do we want to give 7.5%, $7.50 back? Of course not, right? But for the example, you're at 100. Let's just say you decided to give it that kind of room. It's a higher scale play. That's fine. So first of all, I've given an example here. But before I do that, I'm going to write this down. We're going to write $100 entry. We're going to spell it right, though. Then we're going to say 92, let's just round it off, 92.50 stop loss, right? And we're just going to keep that there for a moment. We'll come back to it. Now, let's go over this example. In this example, I said you have an account size of 20,000. Now, if you're working with an account size of 10,000, 15,000, 100,000, 2 million, 10 million, 15 million, 20 million, etc., then obviously the numbers are going to change. So put your account number in there. If it's less, that's fine too, whatever it is. Then what you're going to do is see that we're going to risk what? 1% max. 1% max. You don't have to risk 1%, right? So if you have a 7-figure account, do you have to risk 1%? No, not at all, right? That's a fact. Unless you were very good as a trader, there was no reason to do that at all. The other side of that is that I will do another caveat, which would be this. Let's just say that you tell me, look, I have 100,000 to invest, but I don't like to keep it all on the exchange. On the exchange, I only keep 20,000. That's fine. If you want to risk it as if it is your account and say I want to do 1% of what my actual account is, which is at 100,000, because I have the rest in fiat on the side or cold storage or whatever, that is absolutely your right, and that would make sense. Hopefully you guys followed me. If you're in that situation, you probably did. If you're not in that situation, maybe you didn't follow it and you can just ignore it, but that would be understandable. But the idea, though, is whatever your portfolio is worth that you're willing to trade on your own, you say, okay, that amount, multiply that by my risk. In this example, 20,000 times 1% risk would equal $200, right? Now, we already said 1% or less until you're a very confident trader. In this example, Litecoin was $100. Let's just say we had a tighter stop loss of 98, and your stop loss was then what? $2 of risk. You guys follow me so far? That means if it got to 98, let's say we did a little lower time frame play, we said, hey, if it backs up to here, we're out. That's fine. We know we're risking $2, right? So what do we have to do? We have to divide, right? The money at risk, which is 1% of our portfolio or $200 max, divide it by $2 or the cents or whatever it might be. And that's going to give you the amount of coins, the amount of shares you can purchase, etc. Now, if you didn't get that, rewind that. Watch it over a few times, but pretty simple. $200 divided by 2 equals 100. This number In this example, it gives you 100 shares or 100 coins, etc. So that's 100 shares. 100 shares times $100, I should put, because that's the cost of Litecoin. Let me make this a little clearer for you guys. And that's just to be crystal clear, cost of Litecoin. And this equals a $10,000 position, right? So you didn't put a $200 position. No, you put a $10,000 position on Litecoin. Now again, you don't have to do the 1%. You could do a 0.5%, etc. So if you have a $100,000 account, does that mean you have to buy $50,000 of Litecoin? No, it's saying, hey, that would be your max, right? So it's very key to understand, because a lot of people think like, hey, I don't have the ability to put X amount or Y amount or whatever it might be, that's fine. But the other side of it, or I don't have the confidence to do it, that's fine also. Go less than that number. We're showing you the maximum, right, of good risk management. Now, that's an easy one to figure out, so I'm going to change the numbers up a little bit. Now, again, I'm hoping you're following this. If not, certainly write this down so that you understand it. And I understand there might be some calculators. If the calculator shows it to you this way, feel free to use it. If you want to send me that calculator so I can review it, that's fine as well. But it's important that you understand the math behind it. First thing you do, determine your stop loss, right? Then, how much is at risk? 1% of your account. Okay, so you take that amount, right? The amount at risk, which is the most you're willing to risk on that trade, divide it by the stop loss, $2 in this example. This one will be a little bit more. Okay, so this one, just so that you know, I want to have everything in writing that's clear here, even though we haven't really got to this one. A $7.50 stop. Now we've already established this is far away, but hey, maybe this is a longer term play. You want to give it room, etc. That's fine. All right, so here we go. Going back over this one, $2 at risk. Simply divide your $200 that you're willing to risk per $2 stop loss. That allows you to buy 100 coins. That's what that's telling you. Okay. So we're going to do this example too. I want to do one more piece of math for you. Okay. Same thing. Let's change it this time. Let's say your account is 50,000. Okay. So now the account is worth 50K. I'm going to just go over with a calculator on all of it for you. 50,000. Okay. Bring my magic calculator back up so everyone can see it. So obviously we know what 1% of 50,000 is, but we'll go ahead and do it right here so that we can all see very clearly is what? $500. So your account is worth 50,000 and 1% risk is $500, right? Now, we already established $7.50 will be our stop loss. Our stop loss risk. Obviously, the stop loss in this example was 92.50, right? So what do we do again? Bring back our calculator that likes to keep disappearing on me behind the scenes. And see what we do? We divide the amount right there, 500 in this example, divided by how much we're willing to lose per coin, per share, whatever it might be, whatever you're trading. And then that's going to give you 66. What is this number 66? Well, pretty simple. 500 divided by $7.50 equals 66, which means we can purchase 66 coins, which is what? 6,600. There you go. And that's because we had a larger stop loss. So now I'm going to leave that example right there so that you understand it. You can look at it. But now I'm going to do one that's going to throw you off a little bit. Now I want to say, I like this for a breakout, but in reality, I'm feeling pretty confident. And this happens. Let me show you 1 hour, and then I'll go back to the daily just for the fact that I want to write this in nicely. So let's just say you're here, and you say, look, I like how this is looking. Let's just imagine this is 100. You say, hey, I like this as a breakout right there. This was 100, and now here this is, $99.60, right? You're feeling confident. You're giving it 40 cents room only as an example, okay? So if you get a setup like that to where you say, look, I'm feeling confident, but if I'm right, this is my new support as an example. Let's say it was right there. This would make sense. But if you were in a situation where it just went over, you're thinking, all right, that should hold. No problem, like good market structure, right? When you have good market structure, what happens? Comes up, it's fighting, breaks on through, holds, breaks on through, holds, right? So let's say you decided that, hey, my mark from 100 is $99.40. I believe it broke on through. If not, it was a head fake. I don't want in it. That's going to happen. You're going to do that on day trades, especially, or things you're trying to jump in. If you can identify an area to where you say, look, I'm pretty confident in my stop here. So therefore, I'm going to have a very tight stop. But something interesting is going to happen. We're going to go back to a smaller example. Let's say 15,000. Okay. So first thing we're going to do, I'm going to go ahead and write this example here. $15,000 account. 1% risk is 15,000 times 0.01, which means we can only risk $150, right? $150 risk. Our stop loss we're establishing is 40 cents. Okay? Stop loss is 40 cents away. That's it. So what do we have to do? We're going to divide $150 by 40 cents. Did we say 40 cents or did we say it was 60 cents? Whatever it is, we'll put 40. We're going to bring our little calculator back one more time. $150 divided by 40 cents. Now, let me just make it 60 cents. Let me hide my calculator so I don't have to keep bringing it up. Let's say your stop loss was at $99.40. I think that's what I said. So 60 cents, right? It doesn't matter. Sometimes it'll be that tight too. You can enter, say, hey, you know what? I like this spot. And then look, sometimes it just changes on you. What you thought you were seeing, right? You got in because you thought it was about to break out. And it reversing and giving up that support resistance. Right? That's actually a wise decision. If you dropped $150 on that, that's okay. Your reward was probably much greater if you were right. So that's the idea behind that. Anyone notice I just made my calculator disappear again by making that mistake? All right, here we go. So what do we do? $150. As I mentioned, we're going to make the stop loss now 60 cents, and I'll change it in a minute, which gives us 250 as a number, right? So we're making this 60 cents, as I just mentioned to you, divided by 60 cents, and this equals 250 coins of Litecoin. Now, if you're sharp, you might have just seen something that's going to say, what does that just mean? 250 times $100 per Litecoin is what? 25,000. Which means equals position size of 25,000. Now, what do I just show you this for? 15,000, 25,000. And of course, 15, let's give it the dollar sign. 15,000 is what? Less than 25,000. Pretty obvious, right? Which means what? To even make it to 1% risk, we would have to use margin. Now, do you have to use margin? Of course not. If you don't know how, don't worry. We're not going to teach margin right this second, but don't even worry if you're not utilizing margin. But you can see what's the point of me bringing this up is that sometimes even to get to 1%, if you have a reasonable stop that's close enough, you would have to go into margin just to make it there. So in this case, you don't have to go into margin. Technically, you just would be utilizing your account size of 15,000 and you would be utilizing less than 1% risk. You would basically put yourself in a position to where you're at 0.6%, which is fine. You can do that as well. But that's just to show you. So, sometimes you'll see it, when sometimes you might think like someone that's doing a 2x or 3x is being irresponsible, but that's not always the case. See, you can utilize margin effectively, and I'm not advising you guys to do that at all until you're good at it. I'm just making a point that that's when you use margin. Now, these guys that are doing, 100x, now there's a reason for that as well. That has to do with how much money you want to have on exchange. If they have the money offline or off chain, that's fine. That's up to them. But as far as just literally having a small account and doing 100x, that's silly. But ultimately, in this situation, there are times where your stop is close enough to where it makes sense to utilize margin, and it still keeps you in the guidelines of 1%. Now, by the way, let's say now you're an established trader, right? Suddenly, at 2%, that would be a $50,000 position. At 3%, you would have a $75,000 position. So you can go on an exchange that allows margin. You would be at 5-to-1 margin. And yes, you should still be at risk for that. In this case, it's 3%. So instead of a risk of $150, it would be a $450 risk. But suddenly you have the advantage that, if that makes, a 10% move, if you went from 100 to 110, pretty simple math, 75,000 times 10% would be a $7,500 reward, right? So in that case, you had a $450 risk, and the reward ended up being $7,500. It's good math. That works out. So wait till you become really good as a trader to where like, hey, I'm costing myself money by not stepping up my risk to 2% or 3%. Until that happens, you're not costing yourself money because you don't have the capability to win consistently at higher levels. So don't. Even 1%, you should wait until that's someone that still can trade a little bit, right? Ultimately, because if you lose 100 in a row, it's not likely. But if you dropped 100 in a row, you'd be hurting. Of course, it's not 1% this time is less than 1% next time, but it wouldn't bring you down to zero, but you'd be in bad shape. The idea, though, in this type of situation is that you're going to be in a position to manage your risk, and then as you start to hit on them, the runners, as usually run pretty well. So if you can stick to a disciplined stop, utilize this basic risk management, it's going to put you into a position to be a little bit more wise. So I just want everyone to have that because we've had some conversation. Certainly I've said this before, but I posted things about it. I posted things on Twitter. I posted it up in Discord previously. But so you know what? I want to make a video for, first of all, everybody that you can watch at any time, at any point in the lessons, and probably have people, even the newcomers will start with this just so they have an understanding and looking and paying attention to it. It's my message when everyone starts of, hey, be careful, be wise, be smart, be responsible for your trades, etc. But at the same time, I hope that this is something that can galvanize that a little bit more and make it make sense in your mind, because ultimately you can utilize 1% and still have a healthy position size if you're picking stops that make sense. Now, do you want to give it $7.50 range? No. But if you're giving it, a couple percentage points on a loss, it's still going to give you a sizable position, right? The $20,000 account at 1% on a $2 stop loss was still able to take a $10,000 position, half of his account. There's nothing wrong with that. If that made a nice run of 10%, the guy made $1,000. That's amazing, right? That's a good thing. So you'd be in a good position ultimately in that situation. You could gain 5% on your account. Terrific from one trade. So that's the key, risk management above all else, because when you bet more, right, and it's betting when you're in that situation and you don't know how to trade, all it's going to do is ultimately cost you more until you're winning consistently. Because if you're not winning with 1%, you're not going to win with 3%. It's common sense. I mean, ultimately, if you're losing a little bit with 1% or less risk, you're going to lose more with 3% risk. That's just the simple math of it. You start to baby step up as you become a better trader. And then it takes even more discipline to not go further, because when you become good, look, we'll get into those stories down the road. You think I'm a perfect trader? I'm not, right? One, I lose all the time, but two, I had problems in my life where I got a little too confident. I mean, I'm talking about when I actually became a good trader, and certainly didn't respect this, and it got me. I got hit hard, like real hard, real money, making decisions of I'm right for sure. I'm a great trader. Don't worry. I know I got this. In that situation, you could put yourself in a tough spot. So that's it for risk management. Read this all over. Watch it a few times if you need to. Feel free to ask me any questions, of course. We will talk to you soon. This is Mr. Anderson, and I'm out.